Welcome to Macro Atlas. Today we're going to be discussing the theory why the US has a political and economical incentive to push oil price down whenever it actually reaches the levels around $120 a barrel. All right. So we've seen that actually play out 2 times. And I think it might play out 1 or 2 or 3 more times. As long as we are in a regime that is reactive to news rather than actually macro conditions and what is happening. Because whenever oil reaches those levels, you get some peace negotiations or relief of supplies, of oil reserves, or fake news about peace talks, right? And all that, and opening the Strait of Hormuz. And then you get this abrupt move, very quick move to the downside. There's a pattern being playing out. So I noticed this when I was doing some research to not actually trade oil, but I was thinking to trade Bitcoin, right? That's how the idea started. The idea started that if oil prices stay elevated for X amount of time, which we determined in previous videos to be around 2 to 3 months, we can actually see that research still visible here. Then that will push inflation to headline inflation, then core inflation, and then the Fed will be hawkish, and this will put pressure on risk assets to go to the downside. Most of those conditions actually were met, but risk assets has not moved yet, right? And trading risk asset, when they're just consolidating and making decision, gets traders cut, they lose through what they say, death by 1,000 cut, right? Because you're just trading the consolidation range. But instead, if you don't trade oil, which I haven't traded oil much, but if you never traded oil, then I'm going to give you a reason at the end of this video of why you should consider it. Because it has a nice structure and it is the center of attention, right? So each regime has an asset that can be traded very good for that regime, where it moves, and it moves in a rather predictable pattern through some speculation, probabilities, and research and conducting theories, right? Well, not all assets have, each asset has its time and place. But I think the time and place right now is for oil. I'll explain why at the end. But for now, let's jump on how we got that idea. So the core hypothesis, all right, when oil enters a high stress regime, right, so macro stress zone here, elevated for 1 to 7 days, the US has both the incentive and tools to suppress it, leading to policy-driven pullbacks or even event-driven, like the peace talks and negotiations that failed. So through some research, we concluded that levels between 70 to 83 is normal for oil prices. I mean, it's a little bit high, but economies can operate normally, and there's like 10 to 20% risk of anything bad happening, right? If an economy is doing good, it can be absorbed. But above that, and until 100, so between the 85 to $100 barrel range, it pressures the economy, right? I mean, it's not good, but like governments can live with it if it's needed, right? That was the theory. But then when we reach 100 to 120, this is a macro stress zone, and this was done on here, right here, and then we got the wick here, and then we were starting to actually see some pattern play out structurally, not just fundamentally. This was a fundamental, it was a macro view, right? But now the structure is confirming the fundamental. Therefore, I'm seeing it as a good trade, and it is also, we're in a event-driven regime for oil. Every time we get pullbacks and on headlines, and just usually oil moves through other things, right? It's through supply, through production, through distribution. Oil is driven through factors as such. But right now it's moving on news headlines, which makes you wonder, as long as this is true, this holds true, that oil is operating in a narrative relief rather than structural relief, then this trade works out. right? So there are two regimes. I did some research to actually contextualize the trade and make sure that it is a low risk opportunity, right? So narrative driven spikes setup works. They work in war, fear premium, speculative positions, and headline driven price. That's what we're seeing right now. Prices can reverse fast. But structural supply shocks, the setup fails because it's all about physics distribution, shortages, and of course shipping blocked. So right now we're actually in the narrative-driven regime, and we should keep in mind that the regime can shift anytime, right? So that's the thesis. This is the macro view, and this is why the thesis work as well. So high oil prices means higher CPI prints, right? And if there are higher CPI prints, that means there's less rate cuts and weaker growth. Now, no government in the world want their economy suffering, right? Especially in times of war, you need some income, you need money, you don't need any financial problems to deal with right now. You need to be financially strong to fund your military and fund your influence to be able to win a war. There's a lot at stake. So governments like in World War II or World War I, they let their economies slip, but it was during the war and at the end, right? At the start, you need a strong economy. And we can start to see that in Russia. So in the first 2 years, their economy was doing well. They were printing money. They wanted their economy to do well to support their operations. But right now, you start to see higher inflation and weaker growth, and actually, people there personally tell me prices are going up much and much higher. And people are becoming less and less happy. Their income is decreasing, and they're feeling the crunch in a way. But that wasn't the case 2 years ago, right? So yeah, war naturally makes economies go down, but at the start of the war, at least you need to be financially and economically strong to be able and to win your enemies, right? So this is why I think the administration, the US administration, has not only the incentive but the tools, especially that the market is being narrative driven and is complying with any news about opening the strait or peace talks or seeing a light at the end of the tunnel. And whenever you get bad news, oil price slowly starts to go up, not abruptly. Not abruptly. That's the key word here. So there's an abrupt movement always. You can see it through these candles, right? Even if we zoom in more, you would see it. Even everything happens in around 4 hours when you drop. But going up takes a long, long time. So there's a coordination. Some people are already playing that trade. And those people have quite the money. And not only the money, the resources and the intelligence and everything, the position. Look at that. Large volume. In 4 hours, we had dropped from top to bottom 15% for oil. That's not a risk asset, that's a commodity. And yes, sometimes they can drop abruptly like that, but that's not the norm. The norm in good conditions, as you can see, it's pretty stable, right? It's very, very stable in such conditions. But we're getting abrupt movements now. You get it like that sometimes, of course, but most of the time you're stable. I mean, economies, governments, people rely on oil. People have an incentive to keep oil stable so it doesn't cause inflationary or deflationary problems, right? People will be unhappy if their gas tank today is one price and tomorrow is 20% up, right? That's why you have to keep it stable. Of course, it wouldn't go to the pump that fast, but if oil was not stable, I would imagine we would see that change be abrupt in petrol stations, right? Not only in markets, but because it was stable, gas stations can operate in a slower uh, manner, right? And do not pass the cost very fast, but they can understand averages and predict trends and what blah blah and whatnot, right? So yeah, not happened one time, but 2 times already. And that's enough for me to notice a trend. So the trend is there. There's institutional playbook that is being played and that is visible. There's a theory behind it that is economical and proven structurally. But of course, that doesn't mean that it's going to work out. Always, this is not financial advice. This is only for educational purposes. So this is a theory that I'm sharing, and I hope it finds some people that can use it, right? My channel is not really famous, so I don't think it would affect the market in any way, right? So sharing it has a large value. With that said, let's discuss more points on the theory. So especially sensitive under. So this theory, why this works out, and why the government administration has an incentive to lower oil prices in such conditions. It works in such regimes when you have election cycles, fragile growth regimes, and already elevated inflation. So governments around the world, and especially America, here we're really focused about America, but I think that can be applied in many places. Election cycles, we start to hear headlines on the news about that. People start to talk about that, right? We haven't really seen that a month or two ago. So it's not really good for Trump or the Republicans to have oil prices elevated and say, oh, he's not doing the right job, you know? So they have an incentive to suppress oil prices. Fragile growth regimes around the world, and especially in America, everybody's scared about slower growth. This is not like surprising, right? Weak employment already happening. Recent graduates cannot really find jobs in America or around the world, to be honest, right? Employment rate stable, but pretty fragile, and you have elevated inflation. So recently, we literally just got a higher print on inflation, core inflation. And if you want to see headline inflation, it's looking spectacular. It's beautiful for that theory. It's scary. So why core inflation goes up first and then headline inflation? If core inflation is on the theory that we discussed, supposed to show a higher print in 2 months. We showed it earlier, right? We said that we should expect a higher print on headline inflation, a much higher print, and we did get that. But core inflation, now I was expecting maybe we stay constant, but it's actually elevated because the effect of oil is not included in the calculation of core inflation. So we should really expect to see that the influence of the oil spike and the new regime of the new oil price be reflected in core inflation a little bit later, right? But it's still, if it's going up now, what's going to happen when we reach that 2 month mark? Because that 2 month is from the time we actually enter the pressure building zone and stay within it. But I'll believe if we continue being in the macro stress zone, it's 2 months. But if in the pressure building, it was around 3 months from some research and previous history. So, okay. So that's the theory. Is there proof that this already happened? We already discussed it a little bit structurally, but more macro view, fundamental view, you get strategic petroleum reserves being released, sanctions flexibility. So the US has allowed Russia to sell its oil and even unsanctioned some Iranian oil, right? I mean, progress in negotiation headlines when it wasn't true, and then ceasefire negotiations, which have failed just this morning. And therefore, you start to ask yourself, what's next? What's next? And when? And when? That's the key. When? I'll believe when we enter again the 120 range, and I'll put like some positions there. I'm not, again, not financial advice. This is just a trade idea that I'm sharing, and the theory behind it, the structure, and the full setup, right? I would enter somewhere there, right, in this circle. One, because it confirms to the macro view of pressure, macro stress zone. Two, because structurally we should find rejection there on the resistance of the ascending channel. But then when we go down and we go up, structurally this doesn't make sense. Economically, it should. These two do not align. I would probably be less keen on the idea, and I would wait and see what's the new resistance. So if we get again rejected there, then I would shift my view and be like, yeah, that's the true resistance, and that's just a pattern that we're gonna break, right? But if we do that, then regime is about to explode even higher, oil will spike higher, things will get much worse, and structurally we are validated to just go slowly higher and higher, right? Which is bad for everybody. We don't want that. We want to structurally contain the idea till it fails, till we switch from a narrative relief regime to a structural relief regime, where we actually see oil reliefs on rebuilding of oil refineries, or opening distribution, or having more ships pass by, or some alternatives. Stuff that matter for oil, not headlines that influence oil prices. And if you think about it, there's also something I was reading in a book recently. People think that speculators in the market are forward-looking and we predict the future. But it also works in reverse. The future is somewhat dictated by speculators. So you see, so if you're a trader, you know you're making a future out there. You know you're making a future based on that theory. So you can see every time we're getting some oil spikes, we're getting some peace talks, negotiations, and that of course changes the course of history and how those two parties, Iran and America, would interact with each other, because this is being more nice, this might be more nice, and we might actually shift to a different future direction. But in no scenario do I see this conflict easing out anytime soon. And therefore, oil is at the center of this conflict. And if it is at the center, then it will be the most volatile. And if it is the most volatile, then it's nice to trade, right? You can understand some setups. So who can predict the future of this war and the future of oil? I think has an edge, an advantage to predict the movement of oil itself. And this is why I think if you have not traded oil before, and if you traded other assets, maybe add this to your arsenal, because I'm going to add it to mine for sure. It doesn't only teach me how to trade oil, it teaches me how to understand the world as a whole. If you enjoyed this video, please like and subscribe, and I'll see you in the next one. Peace.